Hello warriors, hope you are all doing good. So in this video we will talk about one interesting strategy which is a deviation or alternative of butterfly strategy. So this is a good strategy, and nowadays if you see whether it is Nifty or Bank Nifty, Nifty alone is moving more than 400 or 350 points in one trading session, and Bank Nifty you don't have to, I don't have to tell you, Bank Nifty is a index which is moving 1600 or even 2000 points. So in this kind of market we need a strategy where, or let me put it this way, this strangles, straddles or ratio spread or any non-directional strategy or any market neutral strategies are not working, right? So if you have seen Nifty, it has moved more than for 800 points in two trading sessions. And if you see Bank Nifty, it has moved more than 2600 points in two trading sessions. So these kind of markets are highly volatile, and we are into non-directional strategies. Like I told, we are into strangles, straddles, or these are all non-directional strategies. Now we want a strategy where if our direction is, since the market is moving violently, if our predictions are right, we make profit. If our predictions are wrong, we exit with a very minimal losses. So it is this strategy is a high risk reward strategy. As I told you earlier, this is very simple strategy. If you Google it also, you will find this butterfly strategies. But we are going to alter that butterfly strategy in our favor, so that if our predictions are correct, we make good money. If the market doesn't move, we make very good money. And if the market moves in our opposite direction, we also try to do adjustment and we exit with a small loss, right? So that is what we are trying to do here. So I'll without any delay, and make sure you watch this video till the end so that you understand this concept clearly. And in case if you have any doubt, you are obviously you are welcome, and you can post on the comment section below. So now without any delay, I'll just show you the strategy here. Now let me clear this one, okay? Yeah. Now, what is butterfly strategy? You know what is butterfly strategy? It is a very standard strategy or a very basic strategy. It is a limited risk, limited reward strategy. Now, let us say market is at 17,200. Okay. To construct first I will tell you how to construct a butterfly strategy. Then we will do some arrangement, or we will just try to manipulate this strategy, or we will try to make the strategy in our favor so that our directional view goes right. Now if you want to construct a butterfly strategy, what I will do is, market is at 17,200. I will buy 17,250 call option. Then I will further go on the upside, sell maybe two lots of 17,450 call option. Then further upside I will go and I will buy 17,650 call option. Now this is a standard butterfly strategy. You don't apply any logic. You don't ask me why that tent is not in the center and all. Just for explanation, just to make you understand, I am just simply constructing this strategy. Now if you see this strategy, there is a ratio of 1:2:1. Now we bought 17,250 call option one lot. Then we further went upside. We sold 17,450 call option 2 lot. Then we further went upside and we sold 17,650 we bought 17,650 call option 1 lot. So this is a 1:2:1 ratio. Now how do we manage this one, or how do we change this strategy in our favor? Let us say you are bullish, you are expecting the market to go to 17, you are expecting the market to expire somewhere between 17,200 or 250 to 17,500, or simply talking, you are expecting the market to go on the upside. Say for example, you are expecting the market to go on go above 17,500. Now what I will do, instead of buying 1:2:1, I will just make 1:3:2. 3:2. Right? So once I do this, I think I told you bullish. You are expecting the market to go bullish. Actually, I should have told bearish. Since we are bearish, no, I told you in opposite thing. Let's say you are bearish and you expect the market to go on the upside. Now what I have done here is, instead of 1:2:1 ratio, I have changed that to 1:3:2 ratio. Maybe if we move this one 17,700 call option further upside, we will go to 17,800, right? So earlier we sold 17,650 call option, 2 lots. Now instead of 17,200 call option, we are buying 17,800 call option. Or we can even, if we go further upside, we are going to have a we are going to exit with a minimal profit if the market keeps on going on the downside, right? Now you will ask, and since the third leg, the 1:3:2, one is you are buying the first leg, you are buying at the money call option, then after 300 points or 200 points you are selling 3 call option, then you are going around how much, 500 points away, and you are buying 2 call options. So 1:3:2 ratio, right? Now if you since you are doing this, the more the third leg, the more it is nearer to the second leg, the losses will be less when you go on the downside. The more further you go, say for example the second leg is at 17,400, this 17,450 call option which you have sold, maybe if you go on the upside, let's say you go to 17,600 call option 2 lot, and if the market goes on the downside, you will be in a small loss. Say you go further, you go to 17,900 or you go to 18,000 call option, you sell 2 lots. Maybe if the market direction, if your view is right, you will make good profit. Not good profit, you will make a minimal profit, right? So this is the strategy. Now you will ask me one question, what if the market moves on the opposite direction, right? That is the obvious question. These things everyone know. Why Umar you are telling these things, you will ask. I understand. You don't have to worry about that. Now what will happen if the market, instead of coming down, if the market shoots up, what I will do? No problem, you will have to do the same thing on the upside. Now I will buy one put option, then 300 points away, 250, I will go to I will sell 3 lots. Then since from 17,450 we went to 17,900, that is around how much, 450 points I think. We will further go on the upside, we will go to maybe 16,550 and buy 2 lots here, right? Once I do this, it is equivalent to be having a non-directional trade. Now market is moving, you are bearish in the market is moving on the downside, then after that it is going 200 points on the downside, then it is coming 300 points, going 200 points on the upside, then coming 300 points on the downside. That is 2-way, 3-way move. Now this kind of move will happen not regularly, it will happen, but it will happen very rarely. In this kind of markets, you can manage these, you can do these kind of trades and manage your position if your directional view. Earlier you were bearish, you expected the market to go on the downside. Instead of going down, if the market is moving on the upside, you will have to do whatever you did on call side, you will have to do it on the put side. Once you do both side, you are protected and your maximum loss is going to be around 32,000 and maximum profit is going to be around 30,000. and you know this is a holiday, today is Sunday, and Sensible will not be giving you good perfect data. And even Opstra, nowadays I stopped backtesting in Opstra because that is not giving any reliable reliable information. So you can have some idea how things can work, but if you believe in Opstra 100%, or if you think that is reliable 100%, I don't think so. So this is a simple strategy which you can use if your directional views go wrong. Now, if you are asking what can we do beyond this point, even if the market moves beyond this point, what you can do? There is no other way. You just book loss and exit the trade and try to initiate another trade. We cannot we cannot trade in this kind of market where the market moves makes two-way or three-way or even four-way moves. You remember one day Nifty was doing a price action, V-shaped price action. So those kind of days and all, you will have to make losses only. There is no other way, but we can just manage these kind of trades like this only, right? So this is a very simple strategy, and you think yourself, so what, this is just an idea. You think how we can manage this, or how you can make this strategy in favor of you, so that you can do some alteration and make it profitable if the market moves in opposite direction. And and earlier also I was telling I was bullish. I was saying the market from 17,200 to 17,500 it is going. So in that case you have to do the put side. But I was telling we are bullish, and I was doing it on the call side. If you are bullish, you have to do it in the put side, and if you are bearish, you have to do it in the call side. You have to remember this. So first part of this video, first 5 minutes or 10 minutes, when I started explaining this strategy in the Sensible Strategy Builder, I told you wrong, right? If you are bullish, you will have to do it in the put side, and if you are bearish, you have to do it in the call side. So you remember this. If you have done it in the call side and market is reversing, you do exactly on the put side. So you are compensated on the both side. If the market is range bound and it is closing in between this range 500 range, you will make a good profit. And look at this one. The total margin required for this is around 1 lakh. And if the market doesn't move, and even if you make around 8,000 or 7,000, that works to be around 7% return on investment, right? So that's it, nothing much. So many people were asking, there are no strategy videos, so I thought I will share this video with you. If you like, do subscribe and share this video. Thank you for watching. Take care. Bye.